Welcome back. Today, we're diving into an analysis report on Tilray's big 12% stock surge, looking at post-split stabilization, its Q1 profit, and overall fundamental health.
It's a really solid piece of work. The structure is there, the evidence from Q1 is strong, and the watch levels are clear. A great foundation for sure.
I agree. But I do wonder if the connection, the direct line between that profitability news and the massive surge is as tight as it could be.
I think the presentation of the 12% surge drivers could benefit from a more unified causal narrative, one that explicitly connects that fundamental shift to the technical validation we saw in the charts.
Right. So the report currently lists 3 drivers in Section 2. It's got post-split stabilization, a delayed reaction to profitability, and then the technical gap and go. They're sort of presented one after another.
And that's the thing. That sequential approach, it almost accidentally separates the real catalyst, that positive net income of $1.5 million, from the technical action.
The accumulation at the $7 level.
Exactly. The defense of that $7 support. The weakness is that by separating them, the report doesn't really show why the technicals held up today versus any other day. It makes it feel a bit like a lucky coincidence.
Which is a critical distinction. I mean, support levels get tested all the time. For that $7 level to hold and then launch like that gap and go you mentioned, it needed a real reason.
It needed a reason that wasn't there yesterday. That kind of move tells you informed buyers are finally stepping in with some real conviction.
So the suggestion?
The suggestion is to resequence those drivers, maybe even combine them. You need to establish that the new financial health, those positive earnings, that's what gave buyers the confidence to come in and just soak up all the shares. It elevates the whole analysis.
So you move from just listing events
to explaining a synergistic market shift. You're showing the fundamentals being validated by the price action in real time.
That definitely makes it more authoritative. So practically, how would that look in the report?
Well, for example, you could open Section 2 with the profitability news. Make that the foundational reason for the whole rally.
The core catalyst.
The core catalyst. Then present the technical rebound, especially that aggressive buying around noon, as the direct consequence of that news. You could even link the timing, suggesting that big volume surge was the market finally pricing in the fundamental news.
I like that. It turns the day's timeline into a real story of building conviction. And that conviction, well, that leads us to the next big question in the report, the long-term targets.
A perfect pivot. The analysis needs to forge a much stronger bridge between today's good news and those really bullish long-term price targets of, $17 plus?
Yeah, the report does a great job defending the current, say, $8 level. It uses the record Q1 revenue, the debt reduction, all that good stuff. But then it just jumps to a $17 analyst target based on, it's pretty vague. U.S. rescheduling catalysts.
And that's the gap in the logic. The current numbers, they absolutely justify stabilizing the stock around $8, maybe $10. But to get to 17, that requires a massive expansion of the company's valuation.
Whole different story.
A whole different story. The report doesn't really provide the milestones or the math needed to make that 100% jump convincing.
So you're saying the current fundamentals get you to $10, but the $17 target needs its own separate quantitative model that just isn't there yet.
That's it, exactly. And my suggestion would be to integrate a short, quantitative scenario analysis right into that section. You need to articulate what success at $17 actually looks like.
Okay, so you want to translate the vague catalyst
into specific financial metrics. It's what any serious investor would want to see.
How would you structure that? What are the key examples?
Instead of just saying U.S. rescheduling, you outline a couple of data-driven outcomes. First, revenue. What's the new market size they could capture? An actual number. What's the new annual revenue needed to justify that valuation?
Okay, so the market opportunity.
And second, the risk. What new EBITDA multiple are you assigning to the company to get to $17? And, critically, why is that multiple reasonable now that the risk profile has changed? You have to show the mechanism.
That's very actionable. It grounds the most optimistic part of the report in something tangible. Okay, so let's go back to that profitability we talked about at the start, the source of it.
Right. Bolstering the diversification analysis for quality of profitability is key here. To really validate this idea of a shift to profitable growth, the analysis has to dig into where the profits are coming from.
The report does note that the craft beverage and wellness segments are a big strength. They provide steady cash flow, support the stock. It sounds like a good thing.
Oh, it is a strength, no doubt. But the analysis treats that 1.5 million in net income as a single monolithic achievement.
And the weakness there is?
The weakness is that we don't know if the core cannabis business is actually profitable on its own, or if the entire net income figure is coming from the non-cannabis segments, from the beer sales.
And if it's all from beer, then the whole narrative that Tilray has figured out profitable cannabis operations, that kind of falls apart, doesn't it? It changes the investment theses completely.
Precisely. The source of the profit matters immensely. If the core cannabis business is driving it, that's a huge sign of sustainable growth.
So the suggestion is to add some context.
Add a brief, qualitative comparison. You need to define the quality of that profit figure. It tells you everything about the sustainability of this rally.
So the key insight for the analysis is whether the market is rewarding them for operational success in cannabis or just for successful diversification.
That's the question. For a concrete example, you could frame it directly in the report. Ask the question, are the positive EBITDA and net income driven by core cannabis or the diversified segments?
And then explore both possibilities.
Exactly. If it's the beverage segment, you emphasize how that solidifies the stock's floor. But if the cannabis segment is now profitable on its own, well, that's the real story. That's the driver for long-term acceleration. And that links right back to the technicals we talked about at the start.
That's really helpful. It tightens the whole argument by linking the technicals to the quality of the fundamentals. Okay, let's summarize the big opportunities here for this Tilray analysis. First, strengthen that narrative. Show the direct cause and effect between the profitability news and the technical search. Make it clear it wasn't a coincidence.
Second, build that quantitative bridge to the $17 price target. You have to translate those future catalysts into actual numbers, revenue projections, valuation multiples.
And third, dig deeper on diversification. Clarify the source of that $1.5 million profit to really prove the profitable growth thesis for the core cannabis business is sustainable.